Many people find long-term care insurance confusing. This short video will give you some basic information about the three types of insurance products that pay for long-term care, also known as chronic care. For information about other funding options, download or view the multimedia booklet, Plan for Longevity. You'll find the link at the end of this video. The need for chronic care is increasing, and the number of people who provide this care is not keeping up with demand. And this is driving already high costs even higher, while the options for traditional long-term care insurance is decreasing. In this video, you'll learn about the major differences between the three types of insurances that pay for long-term care services, and some important information about underwriting, rate stability, and tax benefits will also be touched upon. There are three types of insurance that can help pay the high costs of long-term care services: traditional, hybrids, and life insurance with living benefits. Traditional long-term care is the most flexible. However, premiums are planned and not guaranteed. Hybrids are so called because they provide long-term care benefits, but if those benefits are never accessed, a beneficiary receives a benefit in the form of life insurance equal to or greater than the amount of premium that's been paid. These policies were originally designed for affluent people who plan to pay for long-term care from their money market or CDs. Insurance companies started designing products that leverage those funds 2 to 6 times by transferring low-yielding assets into these hybrid policies, or by transferring cash from a life insurance policy to a hybrid policy. Premiums for these kinds of hybrids start at $50,000 and can go up from there. Life insurance with living benefits is another insurance option, but these policies are primarily life insurance and not really long-term care. The long-term care benefits are actually an advance against the death benefit, and while this is not considered true long-term care insurance, it can be a good supplement. The most common type of payout would be a 2% monthly advance against the death benefit. As an example, a $250,000 policy would pay $5,000 a month for 50 months until the life benefit was used up. The cost of the rider can add 10 to 20% to the premium, and since these policies don't increase in value, buyers must consider the high cost of care today and the increasing cost perhaps as long as 40 or 50 years into the future. If you're considering this type of policy, be aware that there are two different types of riders that allow for benefits for the chronically ill. A true long-term care rider defined by IRS code 7702B will pay for temporary disabilities or illnesses as well as permanent chronic care, and they have consumer protections as well. They bear upfront charges for the rider and must have unintentional lapse protection. Chronic care riders will not pay unless the disability is determined to be permanent. In some states, the benefit will only pay nursing home costs, and there are no consumer protections. The rider doesn't increase the cost of the policy, but it's difficult to determine the future benefit because it's a function of age at the time of claim. It's hard to directly compare hybrids and traditional policies. Think of two children wanting an ice cream cone. One will say to the ice cream man, "Here's $5, how much ice cream can I buy?" And the second will say, "I want a triple scoop with sprinkles, how much will it cost?" Hybrids are like the child who wants to know how much he can get for his $5. These policies typically require a premium of at least $50,000. How much insurance you get will depend upon the age, the gender, marital status, and health of the applicant. Now, hybrids generally are paid in full over a shortened period of time, usually in either one lump sum or over a period of 10 years. Some companies do allow paying to age 65, but the benefit won't be as great. Hybrids offer no choice of waiting periods or elimination periods and no shared benefits or some other riders offered by traditional plans. Qualifying for long-term care benefits is the same for traditional policies, hybrids, and life insurance with true long-term care riders. A medical professional, nurse, or care manager must certify that the insured is expected to need human assistance with at least two of these activities of daily living or to be cognitively impaired. The healthcare professional also has to certify that the condition is expected to endure for at least 90 days. Now, the expectation of the need for care shouldn't be confused with a waiting period. Waiting periods are the time between meeting eligibility for care and actually receiving benefits. During this time, costs are paid out of pocket, just like a deductible in health insurance. Most traditional policies available today are what we call reimbursement policies. That means that when you qualify for benefits, you submit bills to the insurance company, and the insurance company will reimburse you for qualified expenses. Cash benefits don't require submission of the bills. Whatever benefit you're entitled to will be paid. The insurance company will just cut a check each month to the insured regardless of actual costs. So if your benefits are $5,000 each month and your expenses are only $4,000, the difference is yours to use or save as you see fit. Many traditional policies have daily limits, others have monthly limits. That means that policies with monthly limits are more flexible when scheduling home health care services and therefore more consumer friendly, even though the dollar benefits are exactly the same. Elimination or waiting periods are the time between becoming certified as needing care and when benefits are actually paid. Now, don't confuse the waiting period with the definition for eligibility. Waiting periods can be anywhere from 0 days to 180 days in New York, and during this time, the insured is responsible for paying for all the costs. Waiting periods are like deductibles in other insurances, except they're expressed in time rather than dollars. Some companies will only credit a day in which a qualified service has been performed towards the elimination period. Others will credit each day from the time the insured meets the definition of eligibility. Other companies will credit 7 days towards the waiting period if one qualified service has been received during this period, and other companies have other variations. Inflation options are important because, as we know, costs of most things increase over time. However high the current costs are for long-term care, they will be significantly higher in the future. Inflation options are meant to ensure that the benefits keep pace with inflation. Some hybrid plans have no inflation option on the first 2 years of being on claim. The benefit you start with will be the same in the future, which could be many years from now. So make sure you understand what your benefit will be when you're most likely to need care. Benefit periods in reimbursement plans do not determine how long benefits will be paid. They determine what the initial lifetime dollar maximum of the policy is. I say initial because the lifetime maximum of the policy will continue to increase if the policy has an inflation rider. Traditional policies may have additional options for couples. Couples may be married or domestic partners, and in some situations, siblings who live together may qualify for couples benefits. These are the most common types of sharing benefits. Homeowners insurance, auto insurance, health insurance, and other types of insurance offer no refunds if you don't submit claims. Long-term care insurance may. As stated before, hybrid policies have a death benefit if you don't use the long-term care benefits. The death benefit will be diminished by the long-term care benefit paid out on a dollar-for-dollar basis. If there is a death benefit, it will be received income tax-free by the beneficiary. Return of premium options on traditional long-term care policies are usually not cost-effective. They're usually analogous to very expensive life insurance. Underwriting is the process by which the insurance company decides if they'll issue a policy to someone and at what rate class. Every company has its own underwriting standards, and that's why it's so important for insurance professionals to know about your health history in detail. An experienced insurance professional will guide you as to which companies to apply to and which to avoid. However, no agent can guarantee coverage. Applying for traditional long-term care insurance usually requires review of your health records, and depending upon your age, it may also require a cognitive screening by phone or a face-to-face interview. Hybrid plans do not commonly require health records or face-to-face interviews. However, that doesn't mean that they're easy to qualify for. In fact, the opposite may be true. Since hybrids have a death benefit, the underwriters are looking at two things: morbidity, meaning the likelihood you'll develop a chronic illness or disability, and mortality, or life expectancy. The insurance industry has received a lot of bad press about the rate increases on existing policies, and because of this, many people today are reluctant to purchase policies. Long-term care insurance is a relatively new kind of insurance compared to life insurance or disability income. The lack of existing data, changing demographics, and a prolonged low-interest environment created a perfect storm for underpricing these policies. Now that the market has matured, the actuaries have access to newer data and claims experience to create more realistic pricing structures. The fact that today's policies are more costly than in years past confirms that fact that the risk of needing care is greater and more expensive than ever before. And don't be fooled by low premiums. All the insurance companies are dealing with the same risks. Low premiums may be a predictor of future rate increases. Benefits received from traditional, hybrid, or life insurance with living benefits are not taxable. With regard to premiums, some states offer tax credits and some offer tax deductions. New York State offers a tax credit towards your income tax if your adjusted gross income is less than $250,000. The credit is equal to 20% of the premium, and the credit is capped at $1,500. Long-term care insurance is considered a type of health insurance by the IRS, and that means if your total medical costs, including long-term care premiums, are over 7.5% of your adjusted gross income, you can deduct some of the premium costs, but you must itemize expenses. The amount that's eligible for deduction is based upon age and is generally adjusted for inflation. To learn about other ways to pay for long-term care, get your free multimedia consumer guide, Plan for Longevity. This consumer guide also includes a free 1-year subscription to the app Mind Your Loved Ones. It's an app that keeps all the important data you might need at the tip of your fingertips when a loved one ends up in the emergency room. Simply copy this URL into your browser or scan the QR code with your smartphone. Thanks so much for watching. This is Lynn Lavender.